Hi, this is Christina Dubois-Nugent coming to you with part two of Butterfly Strategies, the old-fashioned approach. So when we take a look and what I've shown you so far is understanding from modern view to classic view just how important it is to see the stock activity through the trade. So whether you're trading butterflies or credit spreads or directional debit spreads, that looking at the stock through the chart is a lot easier than having it in classic view where the stock chart or the stock scale is on the horizontal axis. You really want it on the vertical axis. So when you take it apart and you look at how it's built, basically what you're looking at is the combination of the two trades, and let me make this a little bit larger, where if I take the bull call spread, which is the purple part here, and the bearish trade, in this case I'm using calls because where the stock is positioned here, and I actually get rid of the wings here, there is your butterfly. So when you take you get rid of the wings, there indeed is your butterfly. So how does it work? Well, what you're looking for is the stock to move into the range of profit, and often it's positioned a butterfly in such a way that time starts to work for you immediately. Again, I'll show that on another version of this recording as I explain the risk graph more to you. But what we're looking for is for you to catch the stock. So as the stock moves up, you're looking to catch it into that area here. So that's what I'm looking for. I'm looking for it to basically come in to this area right in here. So that's what I'm looking for. So let's take a look at redrawing it again. So if I go in and I redraw this again in modern view, let me get the marker just a little bit thicker. Let's do it this way. Alright, so if I am looking at a butterfly, and again I'm looking at my break even, notice that my risk, if my loss is over here, this is my loss, this is my profit side, you can see my risk to reward is quite different. So what I'm looking at is I'm usually, when I'm close to where the stock is trading very close, somewhere here or perhaps closer in here. And again, this is a bullish version where I'm looking for the stock to move higher. I usually have a reward to risk, so I'm looking at a reward to risk of usually about a 3 to 1. Sometimes a little less, sometimes a little more. So anywhere usually 1.5 reward to a 1 risk. Okay, so my risk to reward is quite attractive. Now when I look at a risk graph, what I'm looking at is I have my buy leg here. Let me do that in the same colors that I did here. So I have my buy leg here on the outsides, and then I have my sell leg in the middle, times 2. Now what I want is for that underlying stock to move higher. So the buy leg, that is my first level workhorse. Now, how do I define workhorse? Workhorse is the driving part of the trade. It's my engine. It's where I get money in the option. And as long as the stock moves higher, even just a little bit, my buy leg is going to retain its value. It's going to retain its value. Okay? So that's what I'm looking for, is for that expensive leg to retain its value. What I also want is my second workhorse is my sell leg, and as the stock moves into that range, and as long as it stays at or below that strike, what's happening to my sell leg? Now think about it. I'm selling options. I'm probably going to have to buy them back. I will have to buy them back if I don't go all the way to options expiration, which 9 out of 10 times I do not do. Probably 9.5 out of 10 times I do not do. I'm going to have to buy them back. Well, do I want to buy back something for more than what I originally paid for it? Or do I want to buy it back for less? And the answer, of course, is to buy it back for less. So if I'm able to originally sell it for, let's say, $1, and I end up buying it back, so I'm going to keep it in pink here, just so if I can buy it back for, let's say, 50 cents, what's my net value? How much money did I net on that if I can originally sell it for $1 and buy it back? Well, I get 50 cents that I get to keep in my pocket. So if I can have my buy leg, which is my first workhorse, if I can have it retain all or most of its value and then be able to sell whatever I originally sold to buy it back for substantially less because this is out of the money and those options or the time value of the option is going to expire faster, at the end of the day I end up making money in this trade. Now you should ask, what happens to this guy? This guy is just along for the ride in order for me to sell two. In order to sell twice as many and be able to take advantage of where time decay is going to be the greatest, I need to have that protection. Because if I don't have that protection and I try to sell two of these, what's going to happen is my margin requirements are going to be incredible and it's not going to be worth it as far as the cost of money to be in this particular trade because of the margin requirements. So at the end of the day, what I'm looking at is a butterfly that I want the stock, and this is again a bullish version, to get into the mouth of the trade and then ultimately stay somewhere right in here, and obviously as close as it can get to being at that sell leg. I'm going to be able to maximize my buyback of those options. Now what we're going to do is the next version we're going to actually look at real risk graphs. Hope this is being helpful. Thanks.